Hello everyone, my name's Elliot Gu. I'm co-founder of Capitalist Times Investment Research and founder of our brand new Smart Bonds service. And I actually just put the finishing touches on an issue of Smart Bonds here this evening. And I think it highlights a very interesting opportunity. And this is an opportunity that's going to particularly appeal to those of you who are looking to earn additional yield income from your portfolio. And in particular, it applies in this case to the bond, right, credit, and preferred stock ETFs, exchange traded funds that we recommend in the Smart Bonds service. So I want to talk to you a little bit more about what I'm looking at, the indicators I'm watching, why I think we're entering the early stages of what is typically a monumental shift in the bond market, and maybe a little bit more about how you can actually benefit from that. So let's get started. This first slide is actually a chart of the yield curve. Now, this is something I've written about a lot across all of our different publications at Capitalist Times Investment Research because it's just such an important phase of every market and economic cycle. And that is a disinversion of the US yield curve. Now, let me back up and explain. First of all, what do I mean by the yield curve? Well, the yield curve in this case, I'm defining as the yield on 2-year U.S. government bonds less the yield on 10-year U.S. government bonds. So in a normal market and economic environment, you're going to have the yield on 10-year government bonds being higher than the yield on 2-year government bonds. And that makes sense, right? Because if you're buying a 10-year government bond, you're taking on more risk or more time value there tied up. In other words, if the economic situation, the interest rate situation, the inflation situation can change a lot more over the course of 10 years, and you're locking your money up for that entire term. Whereas when you buy a 2-year government bond, your yield is going to be more based on expected economic conditions in the short run. However, historically, yield curve inversions have been rare, and that happens when the yield on short-term government bonds is higher than the yield on long-term government bonds. Now, many of you may have heard, and it's actually one of the biggest myths in the financial markets, that an inverted yield curve is a sign of recession ahead. That's absolutely 100% incorrect. Yield curve inversions do not mean imminent recession. The curve often will invert long before the U.S. economy enters in recession. What a yield curve inversion really means is that the market sees Fed policy as tight. So why is that? Well, think about it. What drives up the yield? The Federal Reserve controls more directly short-term U.S. government bond yields. So when the 2-year bond yield is rising a lot, which tends to be what inverts the curve, it just means that the Fed is hiking interest rates and is expected to continue hiking interest rates, right, over the next few months or several months. And the 10-year yield actually reflects more the market's expectations for yields over the long haul, as well as, of course, by extension, economic conditions, economic growth, inflation, and sort of average Fed policy over the next 10 years. So when 2-year yields are very high relative to 10-year yields, when the curve is inverted, that just means that the market thinks that the Fed policy is very tight right now. That's why 2-year yields are high. But over the long haul, interest rates are going to have to come down to a lower level. So again, an inverted yield curve means Fed policy is tight. What you have to actually look for is a yield curve disinversion. Historically, the bad news comes not when the yield curve inverts, but when it rapidly re-steepens out of an inversion. So it regains a positive slope of at least 25 to 50 basis points. And you can see that here on the chart. This blue line, this dark blue line, is the slope of the yield curve measured by 2-year yields less 10-year yields. These sort of, I guess, rose or red colored boxes I've got here, and this goes all the way back to 1986, okay? All the way up to the current present time. These sort of rose colored boxes are the official U.S. recessions over this time period. there have been four, right? There was the 1990, 1991, 2001, 2007 to 2009, and most recently this 2020, the short 2020 recession. And what you can see here is that ahead of each one of these downturns, the yield curve inverted, but the recession didn't begin until the yield curve regained that positive slope. So you can see that here. Before the 1990, 1991 recession, the yield curve regained a positive slope just ahead of the U.S. economy entering recession. We saw the same thing in 2001 and 2007 to 2009. Now, there are a couple of examples, very few examples really, of the yield curve inverting and then regaining a positive slope and the U.S. economy not entering recession. The most famous actually occurred here in the late 1990s. In 1998, 1997, 1998, the yield curve inverted, but the Fed actually engineered a soft landing. Economic growth came down, inflation came down, but the economy did not enter recession. So I think most investors are aware of the bond market's reputation as a haven, a safe haven during economic downturns, during recessions, right? Here's an example. The dark blue line you see on your chart is actually the Bloomberg U.S. Aggregate Bond Index. Now, this is an index of bond prices and yield, so it's a total return index, and it covers a wide array of U.S. Treasury bonds of different maturities, long-term bonds and intermediate-term bonds, everything that has a maturity of over 1 year, as well as investment-grade corporate bonds, and even mortgage bonds, commercial mortgage-backed securities, agency bonds, mortgage agency bonds. And so it's a very broad-based look at the overall U.S. bond market, taxable bond market. And what you can see here is that, and I took this over the period from 1998 all the way up to the end of 2003, the beginning of 1998 all the way up through the end of 2003. And as you can see, I've labeled here on the chart some key economic and market and Fed events that happened over this time period. And you can see that the bond market in 1999, and let me see if I can actually highlight this for you. But back in 1999 and early 2000, the bond market was actually fairly flat, right? And you can see that I have a laser pointer here going for you. Was quite flat. The S&P 500 peaked in March 2000, right? And the bond market began to sort of rally at that time. So when the stock market peaked, the bond market started to rally. The Fed cut interest rates for the first time this cycle in early January 2001. This was a 50 basis point cut. This is a Greenspan Fed, and it was an emergency cut. It was a surprise cut. The U.S. recession in this cycle didn't actually start until March 2001. I don't have it labeled, but the yield curve disinverted, regained a positive slope at the end of December 2000, back here. So the bond market started rallying long before the U.S. economy entered recession and long before the yield curve disinverted. But all the way through the recession, and in fact through the subsequent recovery from recession, which started in November 2001, all the way through the bear market in the S&P 500, U.S. bonds, the Bloomberg U.S. Aggregate Bond Index, produced very nice returns. It ramped up a lot through this entire cycle. And you can see how the bond market really caught a bid, had a tailwind, if you will, through the period of Fed loosening, through the recession, and through the bear market in stocks. So I think most investors are, to some level anyway, aware of this trend, that you have strength in bonds when the economy is weak. However, that's not the only time the bond market performs well. The bond market also performs very well, in many cases, when the yield curve inverts or nearly inverts and then resteepens, even if there is no recession. So this is a similar chart. I'm showing the Bloomberg Aggregate Bond Index as a dark blue line, and this orange line is actually the slope of the U.S. yield curve. That green horizontal line is simply the zero level for the slope of the yield curve. And I took this from 1993 up through the end of 1999. Now, there was no recession in the U.S. over this time period, none. There were no 20% plus pullbacks in the S&P 500. There were some sell-offs, such as in late 1998, but no 20% plus pullbacks, no bear markets, if you will. In fact, the stock market, as many of you are very aware, was actually quite strong throughout this entire period. Now, as I mentioned, a flattening yield curve that moves towards inversion indicates a tight Fed, tight monetary policy. And we saw gradually, or actually fairly rapidly, steep or a flattening yield curve from the beginning of 1993 up through early 1995, right? Where we got down to a slope of almost zero back then. It was a little bit positive on this basis, but barely. And so this period of tight Fed policy, or this period of a flattening yield curve, was caused by a series of Fed interest rate hikes through 1994. The Fed funds rate went from 3% to 6% over this time period. Now, starting in 1995, in early 1995, you can see the yield curve started to re-steepen. So the gap between 2-year yields and 10-year bond yields started to change again in favor of the 10-year. So 10-year yields rose relative to 2-year U.S. government bond yields. But what you can see is that right when this curve started to re-steepen in 1995 and into early 1996, the U.S. bond market, the Bloomberg U.S. Aggregate Bond Index, just took off. You can see that right here, this very rapid rally in this boxed area on the chart on your screen. And so even though there wasn't a recession in this time period, the simple fact that the Fed pivoted and started cutting interest rates in mid-1995, the market anticipated this through a re-steepening in the yield curve that started about 6 or 7 months before the Fed's first cut in the cycle. That alone was enough to power a significant rally in the U.S. bond market. Now, we saw the same thing in the late 1990s. The yield curve flattened out again into late 1998, but there was a crisis back then. The Russian government defaulted on its debt. That long-term capital management LTCM hedge fund blew up. The stock market started selling off in late 1998, and the yield curve re-steepened again from the late 1998 period all the way up through the end of 1999. And the reason it re-steepened is the Fed began to anticipate Fed rate cuts, Fed easing, because of turmoil in markets back in the summer and fall of 98. And the Fed did cut. The Fed cut 3 times, 75 total basis points in late 1998. Again, the bond market had a nice little run from late 1998 all the way up through around the middle of 1999. So, yes, the bond market can be a haven during recessions, but it's also traditionally performed very well when there's a soft landing. No recession, but the Fed pivots on interest rates, which is exactly what we're seeing right now. The Fed has all but guaranteed that it will cut interest rates by 25 basis points on September 18th. That's its next meeting. The market sees the Fed cutting as much as 100 plus basis points over its next 3 meetings through December 18th of this year, of 2024. So I think this is a tailwind for the bond market as a whole. But what's even more interesting in the overall bond market is that different parts of the bond market tend to behave very differently over time. So it's not very accurate or useful to talk about the bond market in aggregate, which is what that Bloomberg Aggregate U.S. government or bond market index does. Because in certain phases of the market and economic cycle, junk bonds will outperform. In other phases, it's going to be investment-grade corporates or treasuries or preferred stocks. or loans, senior loans. All of these markets I track in the Smart Bonds service via ETFs that you can buy mainly off the New York Stock Exchange. And one thing that I'm asked a lot is, okay, but if we buy bonds, say corporate bonds, and there is a U.S. recession, won't that be a problem? Won't corporate bonds sell off in a recession? The truth is, yes, they probably will at some point, but the bond market is a little more forgiving than the stock market around economic turning points. And this slide, I think, illustrates that quite well. This is the lead up to the 2007 and 2009 Great Recession, which was the most severe economic downturn in the U.S. since the 1930s. And what I'm showing you here is the blue line is the performance, the cumulative total return of intermediate term corporate U.S. government or corporate bonds. These are investment grade corporate bonds. The orange line is long-term government bonds, treasury bonds, and that green line is intermediate term treasury bonds. Now, the recession, as I said, was very severe over this time period. It started right at the end of 2007, in December 2007. But what you can see here is that in the lead up to that recession, and all the way up until around September of 2008, all bonds actually performed pretty well. The corporate bonds held up very, very, very well, even though you had the collapse of Bear Stearns in the spring of 2008. You had Countrywide Financial, which is one of the biggest financials in the United States, that was actually taken over by Bank of America at a very low price. And the deal was announced in January 2008, and it was closed in July 2008. So you had all this bad news about the market and the economy. I think it was blatantly obvious by August the U.S. economy was in recession. Yet corporate bonds held up very well until the very late stages of the recession when they began to sell off. In fact, preferred stocks in the U.S., most of which are actually issued by financial companies, the industry at the epicenter of the 2007 to 2009 Great Recession and credit crisis, actually were down less than 5% in 2008 through the end of August. So it's not very important, in fact, to determine whether there's going to be a recession or not this cycle, or exactly when that recession is going to start. But this is a time where most bonds are going to see a tailwind from the shift in Fed policy, and it is a time to begin shifting your fixed income and credit portfolios around in favor of sectors of the bond market, niches of the bond market that tend to perform best when the Fed is easing and in the early stages of a potential recessionary or economic slowdown. So with that, that's exactly what we're doing in the Smart Bonds baseline portfolio, or the Smart Bonds model portfolios. We have 3 model portfolios in the service. We have a baseline portfolio, which is sort of our overall portfolio that consists of only bond, preferred, and credit market exchange traded funds. The inception of this service was the 30th of May this year, so a little over 3 months ago. And that baseline portfolio is up 3.83% through the close on September 11th. So a little over 3 months, it's up 3.83%, including both distributions paid, which are typically monthly for all of the ETFs we recommend, as well as price appreciation. So it's up about 3.83%. That's represented by this blue line on the chart. Our defensive portfolio, which is designed to produce high yields with less price volatility, is still up a little bit less than the baseline portfolio, but it's still up almost 3.3% since the end of May. These are not annualized returns. These are just the total return over a little over 3 months. So these are really good on an annualized basis. And then our final portfolio is our dynamic 60-40 portfolio, which is designed to allocate money to the bond market, preferreds and credit market ETFs, as well as the S&P 500, the stock market. And what it does is, instead of just putting a fixed 60% of the portfolio in stocks and 40% in bonds, which is a traditional 60-40 strategy, right? We change our allocations to stocks and bonds based on both systematic indicators for the stock market as well as discretionary indicators that we follow. So the 60-40 portfolio has done very, very well. It's up 4.83% since the end of May, albeit with a little bit more volatility. And that actually brings me to the part of our performance in smart bonds that I'm most proud of, which is that we've had a very volatile summer, right? We had the collapse of the yen carry trade. We had volatility in equity markets, a big rally early in the summer, big sell-off into August, another big rally into early September, another big sell-off, etc. We saw volatility in currency markets, volatility in economic conditions, Fed policy. But through all of that, you can see a very nice, steady increase in the baseline and defensive model portfolios in smart bonds. And even the 60-40 portfolio, which does have exposure to the stock market, it made a new high at the end of August, the new since inception high in terms of returns, whereas the overall stock market has not exceeded its July highs yet. In addition, it's produced about just under 3/4 of the return in the S&P 500 in that dynamic 60-40 portfolio, with a little bit more than 30% lower risk than the broader stock market. So I think this is to summarize, I think this is a very important moment for the bond market, for income-oriented investors. Typically when the yield curve disinverts, the Fed starts cutting, that's a catalyst for significant upside in these markets. If you're interested in learning more about what we do in the smart bonds portfolios and in the smart bond service, I'd encourage you to take our 60-day risk-free trial to the service, which you can do by clicking the links below this video or by giving us a call on our toll-free number, which is also linked below this video. So I hope you found this useful, I hope you learned something, and I hope to welcome some of you as new readers of our smart bond service here in just the next few minutes. Again, my name's Elliot Gu, and thanks for listening.